Hi everyone, welcome back to the Property Finance Podcast, and today I'm joined by Josh Knight, who joined us actually back in March 2022. So what we've done is a little revisit. Back in 2022, he was a senior BDM for Octane. He's now Director of Sales and Marketing. So quite the
fancy
promotion, I guess. Yeah, fancy this sounds. So Josh, just for those that haven't maybe listened to the 22 podcast, just give us a quick intro and what you're doing now compared to what you were doing nearly 3 years ago.
Sure. Well, firstly, thank you for having me on. Like I say, my name's Josh. I'm Octane's Sales and Marketing Director, which I promise you is fancier than it sounds. Octane, if you're not familiar with us or anyone listening isn't, we're a specialist lender. We offer short-term finance to property investors and developers, principally to help them buy, refurbish, improve the value of property, whether their goal is to increase a property's value or improve its yield. And we've lent close to £2 billion since we launched back in 2017. I've been with the business for 7 years now, so worked my way up through the sales team. My role now is multifaceted in that I still play an active role in the sales team, but I also look after the company's marketing function and sit on the management team.
So just talk to us briefly about where Octane have niched into, because we were talking briefly before the podcast in terms of the fact that there's, I think we said about 240 short-term lenders out there now. So bearing in mind that there isn't really room for 240 lenders in the market if you're not going to niche down, where at the minute are you looking at sort of key niches?
You're right. The bridging market is really saturated. I don't envy brokers trying to keep abreast of all of the different offerings. I think one thing that we've done over the last couple of years is really double down on where we think we're strongest. So refurbishment finance for us is by far our most popular offering. And I think it's actually quite well suited to market conditions, because if you look at where buy-to-let rates are, they've climbed so steeply that if you're a landlord that maybe has historically only invested in single tenancy, turnkey buy-to-let investments, you'll have seen your returns be significantly eroded.
Yeah.
So what we're seeing is investors searching for better returns, and often to engineer value to create those better returns, you need a solution to help you create that value. And that's really what our refurbishment product is all about. So that's really key for us. Another area that we're very strong on is developer exit finance.
Yeah.
And again, very well suited to current market conditions. Developers are grappling with a marked slowdown in sales pace, so that will be causing them concern.
Yeah.
But also construction costs have climbed drastically over the last 4 or 5 years or so. So alleviating that pressure, refinancing the development debt, just buys them a bit more time to market and sell their units, or finish, market and sell their units.
Yeah. And where do you sit with so obviously a lot of lenders have come in with finish and exit products. So just talk us briefly through kind of in terms of development exit, where are you kind of sitting? What's your dream client from a development exit point, if you can kind of call it a dream client? where are you looking to be?
A dream client would be a fully finished development at PC with demonstrable sales traction. So let's say 10 units, 5 have sold, a further 2 or 3 are under offer, let's say, where you're really showing the lender that the assets are liquid. Becomes
a no-brainer then, doesn't it? Yeah.
But I'd be wrong to say that the deals that we're completing look like that. Not many. In reality, the developer is often under real pressure because the units aren't selling. But actually, looking back, 80% of the developer exits that we completed last year were on unfinished developments. And when I say unfinished, we don't really step in at a very early stage unless at a low loan to value.
And you're talking about that early stage being minimum kind of wind and water type, maybe a little bit further than that.
Our sort of rule of thumb is it's got to be in the final 10% of the overall construction budget.
Okay.
If you want us to lend at a high 70, 75% loan to value. Where you're at a low loan to value, so where a developer has built out a site with cash maybe, and they just need a drawdown facility to fund the residual build, that's where we can be a bit more flexible on how early in the development we step in. But so most of the developments that we see, maybe there's landscaping, roadworks, maybe a couple of the units are at second fix.
Yeah.
We step in, clear the development lender, maybe give an extra facility as a drawdown to fund the remaining works if needed. And it just gives the developer a bit more time.
And in terms of that, just I'm going to touch on the probably last point of dev exit, but are you looking to bring your own in-house asset manager on that, or potentially using the existing QS? Like, what's kind of the stance in terms of that, because with there only being 10% of the construction left, it can be a big cost for developers if they've got to bring in another QS potentially to run it.
We wouldn't even use a QS or even an asset manager in that scenario. So really, when we send the valuer out to the site, we ask them to give us an indication of what the remaining units are worth in their current condition, and what they'll be worth when the works are complete. And then very, very rarely would we need to send anybody out to site once the value has been out originally. In fact, even if we're doing a refurbishment or a conversion loan, we still don't use a QS. We use an asset manager, which is very light touch comparatively.
And in terms of that, for those that don't understand the difference between maybe an asset manager and a QS, obviously you mentioned light touch, which anyone who kind of can use their initiative and understand that probably means someone just comes around and has a quick look, some photos maybe. But realistically, what does that actually mean for someone who doesn't know?
Sure. So an asset manager, first of all, is employed by the lender in the same way that a QS or a PMS would be, but the costs are significantly cheaper. So like you say, it's a visual inspection before each drawdown. The way that we fund a refurbishment is that it's done in arrears. So let's say the client spends 50 grand of their own money and then looks to reclaim that 50 grand. We would send the asset manager out to do a visual inspection. They might collect a few invoices to evidence that that's where the money went. And then we would authorise the release of that money. We're talking, £295 per drawdown is the typical fee.
So really almost a fifth of the cost of probably what a QS is at the minute.
And I think, look, we as a bridging lender are incentivised for two reasons to get the money out the door. Firstly, so we can charge interest on it. So we only charge interest on drawn funds. So there's no benefit to us of withholding that cash. But secondly, look, when we're doing a bridge, we want the client to get in and out within the 12-month term. So the sooner they finish that build, the sooner the property can go on the market for sale, or the sooner their broker can start the refinance process to help us be repaid. So, we're very much aligned with the borrower in terms of wanting to keep that project moving.
Yeah, and a big concern, I think, for developers and investors is the length of time that drawdown can take. So on average, what are Octane taking in terms of a timescale of getting that drawdown down? Because it can be a massive, massive impact on cash flow and moving the project forward.
We're talking a week or two from the point of requesting the drawdown. So what a lot of our developers do is they request the drawdown before they need it.
Yeah, of course.
So they'll put that request in, maybe a week more spend on the project, and then the drawdown will be ready when they need it.
Okay. So they're not allowing that desperation to set in. They're kind of able to jump on it early. And in terms of one of Octane's biggest, pros, if you like, is that you're dealing with rolled interest rather than retained interest, which we've touched on it, I think, before, probably in our podcast in 2022, and I've touched on it a lot over recent podcasts. But just talk to us very briefly about the difference between retained and rolled interest and why it's such a benefit for investors, developers, etc.
Sure. Well, look, if you're talking about just a straight bridge, the difference between rolled and retained interest is negligible. So the difference, if you're doing 100 grand property and the lender's at 75% on a retained interest bridge, they'll deduct all 12 months interest up front. And the residual amount that you're left with is post that deduction of interest.
And I think it's worth mentioning on that, sorry, just quickly as well, that they charge interest and fees on that 75% as well.
The downside of the one real downside between rolled and retained for straight bridging is that you're charged interest on, in my example, the 75 grand from the day you take the loan. So then let's say, for argument's sake, that nets to 65. When you do a rolled interest bridge, the inverse works. The lender starts at 65 and rolls to 75 toward, at the end of the term. So your interest is being added rather than deducted. So you're paying interest on a lesser amount from the day the loan completes. But in terms of the amount that you actually get, very little difference. The difference becomes interesting when you talk about refurbishment finance. And this is the key selling point of our product. When a property's value is increasing during the term of the loan, that gives us, as the lender, license to add interest above the 75% rather than deducting it day one. But not all lenders do that. So most lenders...
Very few do.
You're right. There aren't many at all. Most lenders, even if they're doing a refurbishment product, will deduct interest day one. So your net loan suffers. We don't take a penny of interest off our 75% day one lend. It all gets added to the loan and rolled up within the facility, payable on redemption. The product of that is that with our refurbishment product, you get very close to 75% net towards the purchase price, which means that your required capital input as an investor is much less.
Yeah. And just on the straightforward bridge, I think if we put some numbers to it very briefly, just because I think it will help people to understand. But if we take your example where you're ending up with 65 grand in both scenarios, in scenario one where you've got retained interest, if we just use a straight 10% interest rate, just because it's nice and easy for the figures, on the retained interest basis, you're talking about paying 7.5 grand over a year on 65 grand. And then in scenario two where you're doing rolled, you're actually paying 6.5 grand. So the true 10% on that money that you've got in. So I think it's key for people who are sort of comparing apples and oranges. If you've got a retained interest and a rolled interest, it's always beneficial to a degree. Obviously, each circumstance is so different, but rolled would make far more sense because in that one scenario, you're saving £1,000 instantaneously. That doesn't take into account fees and everything else, but yeah, just as a very straightforward, very vanilla set of figures, that instantaneously would save £1,000. I mean, if you amplify that onto £1 million, you're talking about saving 10 grand.
Sure. And that's the thing, every lender does things differently. And that's why, look, we do deal with borrowers directly, but very infrequently. And normally we push them towards a broker because as a developer, it must be an absolute minefield to try and navigate, okay, how much interest am I actually paying over the course of 12 months? How do fees work? Are they added? Are they deducted? What difference is that going to make to my overall profit if it's a refurbishment project? Having a broker to kind of explain that to you is going to be really key for them. Yeah,
I think that's a key point. And hopefully, as a broker, a little sales pitch for myself here, but hopefully we kind of do that for clients is when they come to us, sort of lay out all of those options and hopefully they can understand that very quickly. But in terms of, you mentioned about dealing with clients directly, so I think it'd be key to kind of talk through very quickly, what are some of the negatives that you see from clients? So whether it be experience, cash in deal, etc. What sort of things are you seeing at the minute that turns you off a deal?
My biggest bugbear is where the client hasn't really scrutinized their own numbers.
Yeah.
So like if we talk about refurbishments for a second, let's say your client is buying a property with the view to adding some value and then selling it. When we're structuring our refurbishment terms, there are 3 key numbers. What's it worth now? Or what's the purchase price? How much are they spending on the refurbishment? And then what is the end value, the post-works value? And those numbers together will help us to spit out a profit on cost figure.
Yeah.
And that figure is really key in highlighting when something's off track. So if your client is looking at a project that has a 50% profit on cost by their own numbers, you can say with a high degree of certainty that
something's not right.
One of a few things has happened. Either their cost of works is too low, and that happens all the time.
Yeah.
Their GDV has been inflated, or both of those things are true. And I think that mistake is so easily avoided by just sense checking your numbers. Yeah. We were talking about this on the way in, weren't we, Michael? Where a valuer is only going to look at sold comparable data to arrive at their post works figure.
Yeah.
In the event that it's a sale, and that's all publicly available information. What are properties transacting for? Similar properties in a similar location transacting for in that area.
Well, quick look on Rightmove, and you found exactly what the agent is going to be looking at as well, or the valuer, sorry.
So that's really key. I guess the other thing for a lender is you just want as much information as you can, and it needs to be accurate. And I think when a broker is submitting an inquiry to a lender, there's a degree of persuasion going on. You need to present that case in its most positive light. So, okay, let's say the client doesn't have lots of experience. That's not a good thing. The lender wants to have confidence that your client can see this project through to a successful conclusion.
Yeah.
So let's say the client doesn't have experience. So what are the things that you can do to alleviate that lender's concern? Do they own other assets? Does that mean that their PG carries some weight? Have they built a professional team around them to support them? Do they have a contractor lined up? Have they consulted an architect or a planning consultant in the event that it's a planning or a PD project? Do they have a managing agent lined up to help them let the property if they're retaining it post-refurbishment? These are the things that are going to help build that confidence from a lender's perspective in your client's project.
Yeah.
Giving that to the lender at inquiry stage is really key. Chucking something in, my client's doing this heavy refurb, they don't have any experience. We both know what answers you're going to get from that lender.
Exactly that.
And you only get one shot at it. So, again, coming back to having a good broker, build your case, submit your inquiry with as much information as you can. And, that art of persuasion piece, make it as persuasive as possible. Give yourself the best chance.
And in terms of, obviously we mentioned about potentially build costs being either inflated or actually too low, what are the things that you want to see from a developer or an investor to kind of give you some confidence that those build costs are right? Because it's very difficult for an investor potentially if they found, so for example, we had one yesterday, someone's put an offer in of 400 grand on a property, they're looking to convert it into an 18-bed HMO. They've put the offer in, they've done a little bit of work with their builder to kind of get an approximate build cost, but they've not gone into the pounds and pennies. Are you expecting at the point of inquiry for that to have happened, for there to be a spreadsheet with how many bricks are needed, the paint, everything else? Or are you expecting an approximate figure and then knowing kind of that's going to develop over time?
Yeah, look, I think you're right. You can't expect a client to send us, at the point we see an inquiry, it's often that a client is just interested in the property. Yeah. They haven't even made a formal offer or had their offer accepted. So it would be unreasonable to expect that they've tendered out a build contract and they've got a full schedule of work. So you take the rough with the smooth when it comes to build costs. It's more the GDV figure. That's if you've done your homework, your GDV shouldn't be miles off.
Yeah.
The build costs, look, we have this mantra at Octane, believe what we're told. So when we have an inquiry that lands, largely speaking, we believe that that's true. The only time that we feel duty bound to highlight that something's off track is where we know for certain that the GDV is way off or the build costs are too low. The thing that we see commonly is where you've got a client that's a really experienced developer and maybe they are looking to do a lot of the work themselves physically. So their labour costs comparatively, if you were going to a contract. So, and that's really where we have to kind of try and meet somewhere in the middle. The valuer might think that according to BCIS data, it's going to cost 100 grand to do a project. The borrower thinks they can do it for 50. If they demonstrate that they've done multiple projects for 50 before, then we can meet somewhere in the middle.
Yeah. And I think that's a key point because that comes up on every single development, every single refurb that you deal with is there's always a difference between the QS or asset manager's numbers and the client's numbers. And it's so difficult as a broker to manage client expectations. And obviously, I'll ask you the question rather than answering it myself. But in terms of that, why is it that the lender has to rely on, obviously I know, but for the viewers, if you can explain why you have to rely on the QS and the asset manager's numbers rather than the client's numbers.
Sure. So let's say you've got a project where the client's doing some structural works. They're doing a big rear extension, double story extension, let's say. So they're knocking down some walls within the property. So in the lender's worst case scenario, and this very fortunately for Octane happens incredibly infrequently, is that we would have to repossess a property. If we had to repossess a property that was mid-build, we then become the owner of that property. We then have to finish that development.
Because it's far more cost effective for you to finish it than try and sell on it.
I mean, look, if we can sell part complete, we might have to, but at worst case scenario, we would have to look to finish it ourselves. Now, we're a lender, not a developer. So if you at outset have relied on, this client can do this work themselves, we can't employ a client that we've just repossessed a property from. So, that relying on the surveyor's estimate of how much it would cost Joe Blogg's developer to complete a project is a safety net to us. But also the point that I would make is it's a safety point to the developer as well. Because you and I both know that build costs have climbed so drastically over the last few years. I think according to the BCIS, build costs are up 25% since 2020.
Yeah, which is a ridiculous increase.
And do you know what? Our head of short-term credit brought up something in our management meeting the other day, which I actually didn't know was true. We've never had a refurb facility, or we've very rarely had a refurb facility where the client hasn't drawn all of the refurb funds.
Oh, right, okay.
So even in scenarios where the client says, I don't need 15% contingency, or I can do this.
They've still ended up drawing it.
They draw it or they use it, whether it's on the project or for something else, they always access it. So it's a safety net to provide protection over those climbing construction costs.
And in terms of contingency, because every lender has a slightly different contingency, and obviously I know it's very much dependent on what the QS advises. But as a rule of thumb, where do you expect those contingencies to sit, whether it be a refurb, a commercial conversion?
10 to 15%, yeah, depending on the scale of the project.
Yeah. And in terms of if a client comes to you and tries to negotiate their contingency down, again, are you looking at trying to meet in the middle, or is that a hard and fast, right, we've got to have this as a safety net?
9 times out of 10, we would have at least a 10% contingency built into the build facility, again, to protect us and to protect the client. And just before I forget, let's say a client does build out, in my example, a refurbishment project for 50 grand, and we've got a build facility in our loan of 75. If they successfully, let's say, get to month 9 of the loan term and they've built it for 50, they're still welcome to draw that 25.
Yeah.
It might be that it just goes into a different project. So that should be viewed as a pre-agreed credit line.
Right, okay.
So that's something that our self-funded refurbishment product, which we can come on to, is useful for.
And they don't pay interest on that either until they draw it, which is a key point as well.
Yeah. So it's not just a safety net. It could be used to their advantage further down the line. I think, again, coming back to the point around experience and how the case is presented, if a client is a really experienced developer and they can show a demonstrable track record of delivering similar schemes with a 7.5% contingency built into their figures, of course we can try and look to be reasonable there.
To be in line with them. And in terms of, so before we come on to the self-funded refurb stuff you want to talk about, let's just very quickly touch on security, which every single lender has to take, obviously. And again, this is a conversation that comes up with every single client, no matter what, which is that every lender wants to take first charge, personal guarantee, debenture, without fail. Unless you're a second charge lender, in which case you're taking a second charge. But in this scenario, on all of your stuff, first charge, PG, debenture. So on your stuff, where are you sitting with PGs at the minute in terms of percentage? Because again, every lender is completely different in terms of the percentage PG that they want to take.
Yeah. So we actually made a change to this recently. So first of all, we only lend on a first charge basis.
Yeah.
Sub 50% loan to value, no PG, no debenture.
Yeah.
In the event it's a refurb, up to 50% loan to GDV, no PG, no debenture. Where we are taking a PG, we can almost always cap it to 15 or 20% of the GDV, or in the case it's just a straightforward bridge or a dev exit, 15 to 20% of the current value of the site.
Right.
So we can always look to cap it, but we would typically take one.
And in terms of debentures, so this is maybe going a bit too in-depth to security now, so we can always jump onto something as we need to. But in terms of debentures, so again, each lender has a slightly different way of operating in that some will allow, so for example, if I have a limited company and I have a debenture with, we'll throw a random name, HSBC or Lloyds or one of the big six, another lender may come along and say, well, actually, yeah, we can do a refurb loan or whatever on a different property within the same company. We also want a debenture. And then you end up with deeds of subordination, deeds of priority, etc. between those debentures. What's Octane's stance on that? Would you prefer to have the client set up a clean limited company and have a clean debenture, or are you happy sitting behind other lenders? Or
it's kind of one and the same, really, because if you've got an SPV that only owns one asset, then your debenture is essentially your legal charge.
Yeah,
it carries no more weight than that. If you've got
but you wouldn't lose the debenture, though. You'd still ask for the debenture.
We would still. Our legal charge is contained within our debenture, so we typically have one just as a matter of course, unless the client has a big objection to it, in which case we can often do without a debenture at all. It doesn't really add a huge amount.
No, not when you've got first charge over the property anyway.
No, exactly. In the event that a client has got a company that they have all of their investment properties within, you're right, there might be lots of different lenders that have a debenture. Yeah. If you're the first, you would then just provide what's called a letter of non-crystallization to the incoming lender, which just sort of carves out your security. It means that you don't have a floating charge over
that bit,
the other property.
Yeah.
But to be honest, our solicitors might shoot me here because this is not my lane, but my understanding is that the PG and the legal charge, the first charge over the property, are the key elements of security.
Yeah.
And I've done lots of deals where a client says, we don't give debentures, and we go, fine, we'll just have a legal charge.
Yeah. Which, to be honest, like you said, they're one and the same anyway, really. You've got exactly the same powers over the exact same property. So having a debenture over a company where there is literally just that property makes no difference anyway.
Exactly.
But let's get back in lane.
To what we know about.
Self-funded refurb stuff. Talk us through that then.
Yeah. We launched this product as a sort of add-on to our refurbishment product. So our refurbishment product, we lend 75% net day one, that net point being really key, no interest deducted, plus 100% of refurbishment costs. One in maybe 10 or 15 clients that we were dealing with was coming to us and saying, look, we love the 75% net. We love the fact that you don't retain interest, but we don't need the refurbishment facility. We want to fund it ourselves.
Yeah.
And at that time, we had no real solution. The only solution we had at that time was to do a bridge. But the downside of a bridge is you have that interest deduction or rolling interest, so that the net loan suffers. So we created this kind of add-on product where we still lend at 75% net.
Yeah.
We have a refurbishment facility, which is sufficient to cover 100% of the project, but we don't charge fees or interest on it if it's undrawn.
Oh, right. Okay.
So it's essentially a bridge, but with 75% net. That refurbishment facility still sits there, but could be viewed as a pre-agreed funding line.
If they go and find something else at auction or something like that.
Yeah. And what it does that's really interesting is it helps developers stay liquid.
Yeah.
So it might be that the developer runs into trouble and they need to make a drawdown to actually fund the refurbishment. And of course, that's what it's there for if it's needed. But again, it can be used as, you hear phrases like revolving credit facility or like hunter's cash. The developer could see another property at auction in month 9 of the loan, make 100% drawdown of all of that cash that goes in towards a completely separate project. So it can be really useful in that way.
Which I don't think, from my knowledge, anyone else offers anything even close to that. And in terms of almost a hybrid of, like you said, a hunting license, a refurb loan, a bridge, kind of all smushed together to kind of create this product that actually, like you said, keeps the developer liquid, albeit actually that cash is protected with you, so they can't go and spend it on frivolous purchases.
Do you know what? I found this interesting. I saw something pop up on my LinkedIn the other day, and it was a broker who had written a piece about don't take bridging finance if you've got the money in your account. And it was almost like bridging's really risky, and if you've got the cash, use your cash. Don't use a lender's cash. And I just think that is incorrect, because I completed a deal last week where the client has £1 million in their bank account. They could have easily bought the property cash. They could have funded the refurbishment with cash. They have absolutely no immediate requirement for our cash.
Yeah.
But what they want is to stay open to new opportunities and to be able to move quickly. This client buys property, commercial property, and takes it through planning. And they typically buy cash, take it through planning, and then go to lenders for the funding at that point. So to use all of that cash that they've accumulated in this project means that they're completely closed off to other deals.
Yeah, that once in a lifetime deal comes up and they miss out because they don't have that cash. And actually the cost of missing out on that deal,
the opportunity
probably
cost, for sure,
far exceeds the cost of a bridging loan. I think, just touching on that, because I think it's a key point as well, I think everyone seems to think that bridging is incredibly expensive. And everyone always seems to have this thing of, bridging's 1% of it, so take 1% a month, for example. But in fact, actually, we'll talk about your rates in a minute, but you're in sort of the 0.7s, low 0.8s. And actually, when you work it out, so for example, a standard buy-to-let at the point of recording this, we're probably low 6s, maybe mid 6s on an HMO product rather than buy-to-let. So on an HMO, you're probably mid 6s at the minute for a decent HMO product. Whereas actually, you then look at a bridge and you think, well, actually, on a bridging finance, I'm probably mid 8s. So actually, the cost of finance difference is relatively slim. But those people who say that bridging is expensive, and this is what really winds me up, are the same people who will pay 15, 20% to an investor.
Yeah.
The same people who will take investment finance and will say, I'll give you 15% return on your money. And you're like, well, that's far in excess of what a refurb. And we've had it before where we've had clients who, they've got an option for development finance in front of them. They've got an option from a private investor in front of them. Both are at 12%. And you go, okay, but the development finance is cheaper. well, how's the development finance cheaper? It can't be cheaper. My investor's 12%, there's no fees. Yes, but the investor is charging you 12% on that money from day one, literally the entire way through. And it comes back to what we said earlier about comparing apples and oranges all the time. It's looking at what is the actual cost of finance. And yeah, to say that bridging is expensive or a bad product or anything like that is just crazy, because actually the uses of it far exceed.
I think most people know that now. I think if I even going back to when I started at Octane, there was this, back in 2018, there was this kind of bridging was often labelled the kind of, you can't get funding from anywhere else. You've got to use a bridge. Your hand is forced. It's the only option. Lender of last resort.
That kind of thing. Yeah.
Horrendous credit, complex borrower profile. No one else will touch it.
Yeah.
Whereas now I think bridging has matured and by most people is accepted as kind of an essential tool.
The cost of doing business.
Yeah, an essential tool to help them buy and add value to property. Just touching on rates, our rates start at 0.74 a month as of the time of recording. The reason I say as of the time of recording is that our rates are base rate linked. So we're one of the only bridging products in the market that is variable. It tracks the Bank of England base rate. If the base rate drops mid-loan term, the rate immediately gets cheaper.
Which we've had, the one that we completed, I think, middle of last year.
It's already dropped twice. So, if you borrowed from us in May, you'll have seen 2 reductions in your rate mid-loan term.
Yeah.
And there's no floor to that. Our margin is fixed. The variable element is the base rate. So 0.74 is cheap. Our highest rate is 0.84.
Yeah.
The other thing to think about as well is I think maybe a lay person, they look at a 0.7, 0.8, maybe a 1% a month rate, and they think, how am I going to afford that? They almost wrongly assume that it's going to be a monthly payment by direct debit.
Oh yeah, we get that all the time. Yeah, clients who say, "Oh right, so when's the first payment coming out?"
Well,
it's not. It's retained or it's rolled or it's And I think a lot of people, when they realise that, again, it comes back to that thing you mentioned earlier about the bridging being bad. It's actually, you've got 12 months, especially on a refurb or an HMO products or something like that. Potentially, if you're buying something that's cash flowing, you've got 12 months worth of cash flow coming in on that property with no expenses.
Totally. No, we roll up. We roll up, if you're looking at a refurbishment loan, we roll up our interest within the term of the loan. We only really get paid when the client redeems the loan. And this is coming back to our point about drawdowns. We win when the client wins.
Yeah.
We want to see you take the project from start to a successful conclusion. You've added value, you've refinanced with a term lender, or you've successfully sold the property. We get paid at that point.
Yeah.
So in terms of a willingness to get funds out to help your drawdowns to fund the project, you can kind of understand that we're aligned in that way.
Well, every other lender, they're getting paid on day one, aren't they? Yeah. Realistically, if they're retaining their interest and fees, they've got that money straight away and earmarked away as that win straight away. So that your best or the client's best interests don't necessarily sit with their best interests anymore.
Yeah.
And I think that's where you sit very differently in that sense. And I think just touching on HMOs, because we've not touched on HMOs yet, and that is probably one of your key niches as well. So just talk us through kind of start to finish really, what you guys are doing on HMOs at the minute and what you're seeing, how the market's performing, etc.
Sure. Well, firstly, I think that the way that the market has moved is really feeding into HMO demand. So if you look, again, as a lay person from the outside looking in, I think you'd look at 2 base rate reductions over the course of 2024, and you'd be led to think that things are improving significantly. And look, they are improving, but the kind of broader economic picture paints a slightly different story.
Yeah.
The government is still grappling with inflation. There's still a mistrust, it seems, in this government's economic policy. But the bigger picture really is that swap rates are still very volatile. And I will get onto HMOs in a minute. I'm going somewhere with this. But for as long as swap rates are volatile, any buy-to-let lender will have a pricing headache.
Yeah.
Depending on how they're funded, swaps are really a driver for a lender's cost of borrowing and therefore their pricing. And for as long as there's that volatility, buy-to-let lenders have to build that into their rate.
Yep.
And for as long as buy-to-let rates are high, investors' returns are significantly affected.
Yeah.
And if you're a investor that has historically only invested in single tenancy properties, you'll have seen those returns be eroded.
Yeah, and you're really struggling at the moment, probably.
So that's why we're seeing investors turning towards asset classes that can deliver them a better return.
Yeah.
So whether that's HMOs or
Service
multi-unit
accommodation,
blocks, service
potentially, yeah.
accommodation, holiday lets, mixed use, that's really the kind of broader picture that's driving this demand.
Yeah.
HMO conversions we love. It's an area we think that our product is really well suited for.
Yeah. This is the refurb product, isn't it, that we're talking about?
Yeah. People buying houses and converting them into HMOs. And we see everything from small non-Article 4 properties that can be converted into small HMOs under PD, all the way up to big commercial properties going into bigger HMOs that require sui generis planning permission. And, everything along that spectrum.
And in terms of HMOs at the moment, one of the biggest headaches that people have with HMOs, and we touched on this while we were kind of walking to the studio, but HMO valuations, how are you dealing with those at the moment in terms of on the refurb product? And again, we spoke about kind of a specific instance as well where we had to deal with someone who had a 6-bed, 6 ensuite, but it has to go on bricks and mortar to begin with because it doesn't quite fit into that commercial. So where are you kind of sitting on those valuations?
Well, it's a minefield. And again, every lender will have their own approach. So firstly, our rule of thumb is any HMO that requires planning permission to be an HMO. So that includes any HMO in an Article 4 area and any HMO with 7 or more bedrooms.
Yeah.
That would always command a commercial GDV. And that's
and when you say that means you specifically go out and instruct
always
commercial.
Yes. And that's where, for anyone that doesn't know how that works, the valuer will take the annual market rent for the property post refurbishment as an HMO, apply a yield to that figure, and then that will spit out their commercial GDV, which will be much higher. It'll be inflated to reflect the fact that this is a high income producing asset. So that's good for everybody involved. That's what clients always want. Where there's a bit of disparity and perhaps uncertainty is if you're looking at a small HMO that can be converted under permitted development. So these are non-Article 4 areas where an investor is buying a house and then maybe turning it into a 6-bed HMO under permitted development. Now, once they've converted it into a 6-bed HMO, from a valuation perspective, what is it? Is it an HMO or is it a house? And that's where there's some disparity. So let's take an example. You buy a house for £200,000. You spend cash converting it into a 6-bed HMO. That HMO will generate 50 grand a year in income. Apply a 10% yield. On a commercial valuation, that would be £500,000. But does that mean that house is worth £500,000? Because houses in the area transact for £200,000 to £300,000. So from our perspective, we would, in that scenario, the basis for our valuation would be bricks and mortar. For that reason, because we don't think that an incoming investor would pay £500,000 when they could buy the property for $200,000-300,000 and do it themselves. That's our view. However, the basis is bricks and mortar, but where the client is spending significant funds converting it into an HMO, in your example, putting 6 ensuite bedrooms, we would ask the valuer to pay attention to that, and we would normally see an uplift from bricks and mortar, not full commercial, but what we would call a hybrid approach.
And in terms of with the HMO, I mean, I think one of the big draws for your HMO, and we've sort of spoken about this before, but one of the big draws for your HMO product is that actually you tend to use the same valuation panel as a lot of the larger HMO lenders. So I'll let you explain this, but what's the benefit for an investor developer for having that surety?
Well, look, firstly, the exit lender might be able to rely on your valuation, depending on how much time has elapsed, or at worst, like you said, instruct the same valuer to do the valuation for their buy-to-let mortgage on the way out. Again, this comes back to using a broker that you're going to use for the bridge, but also use for the exit, because a good broker would think about the exit right at the start. So who am I going to take this to repay the bridge? And anyone taking a bridge should always have an exit strategy lined up. If you can line up the same valuer, the lender that's doing the bridge, to use the same value as the lender that you're looking at for the refinance, that's just going to make the whole process much more straightforward.
Yeah. And I think probably answer my own question by saying it kind of gives that surety throughout the entire process then, doesn't it? Because I think one of the biggest things for you and for the client is actually if those numbers at the end are different, it's just a nightmare for everyone, isn't it? So
if you, let's say that our valuer says that post refurbishment a property is going to be worth 500 grand, your client wants to borrow at 75% on their buy-to-let mortgage once they've achieved that end value, all that you're asking the same valuer to do is that 500 grand you gave to Octane still reliable? Can we still rely on that in terms of the mortgage? So it just makes the whole thing much more smooth.
So moving into talking about kind of 2024, 2025, there's been a big influx of, I think we spoke about this on the way in, but a big influx of landlords into the development space. So before we kind of touch on what you've seen, what you are seeing, how's that kind of affecting things at the minute, that big influx of landlords coming in, and why do you think it is?
Well, firstly, it's been incredibly impactful for us as a business. So last year was our biggest ever year for short-term finance. We did 260 odd million pounds in completions last year, which is the most we've ever done within Bridging. And that seems a bit strange to say that we've had a good year amidst such turbulence.
Yeah.
But that trend that you noted has been the key driver for that. If I think back to when I started at Octane in 2018, we had two types of clients that we lent to.
Yeah.
We had landlords that were interested in passive income, turnkey, single tenancy, buy-to-let investments.
Yeah.
And then we had those interested in developing property, refurbishing and developing. And that line to me didn't seem to blur too often. You had people that sort of stayed in their lane because returns were pretty good in both camps, depending on what you were, experienced in. But what we've seen now is these landlords becoming frustrated that those returns are no longer there.
Yeah.
And the result is some have dropped out of the market altogether.
Yeah.
But some who still believe that property is the right thing for them, the right home for their money, are now being forced to migrate into the other development camp. Where maybe they're looking at their first project, like refurbs, adding value, maybe a small HMO. And that's really where we're sort of riding that wave, because our refurbishment product is so well suited to helping investors engineer value. And we don't mind lending to people without experience, especially if they've already got a couple of buy-to-lets. That's good enough for us.
Yeah. And in terms of that experience, we sort of touched on it briefly earlier on, but really what you're looking for is that professional team to be good and in place. And what are some of the key things you're looking at from maybe the contractor, minimum deliverables that they've done so far? Is there any metrics that people need to be aware of?
Sure. Well, firstly, you're right. If a borrower doesn't have any experience, we can place all of our emphasis on a contractor's experience.
Yeah.
But coming back to presenting the case in the right way, if we don't know who that contractor is, then how can we take any confidence that you're building the right team around you? So getting that lined up at inquiry stage, it doesn't have to be the contractor. And it doesn't even have to be the contractor that you end up using, but just showing to the lender that you are thinking in the right way, building the right team to help you deliver that project. In terms of contractor experience, we'd want ideally an online presence, maybe some previous projects. And ideally they've done 10 maybe of their own.
And that's of a similar size, I'm guessing.
A similar ilk,
I tend to find that, again, another thing that kind of drives me mad is people doing developments or refurbs, and they get a contractor, and it's, for example, we had one where they were building 5 units and the contractor they wanted to use had done conservatories and small extensions, and you go, how?
I think what the lender's trying to do, whether it's the borrower's own experience or the contractor's experience, is align it with the project that they're lending on. So do they have demonstrable experience in delivering projects of a similar scale? And scale, we're talking total build costs, similar nature. So is it a loft conversion or is it a big commercial to resi refurb? And a similar GDV. You don't want to feel like this is their big step up and it's outside of their...
Especially when you've got a developer with little experience, you don't want to then have a contractor with it as well. And in terms of the contractor's financials, how in-depth are you going with the contractor's financials? Right, that's interesting, because there's quite a few lenders who I've noticed recently have started really pushing into the contractor's financials, basically to make sure that they're liquid. I mean, the problem with that as well, I find, and I've spoken about this before, is that going into the contractor's financials is okay if you want to do that as a lender, but it's all 18 months out of date.
Yeah.
And I think
that's a level of detail that seems quite onerous for me. They're not our borrower. And if the contractor goes bust, that doesn't prevent the borrower from being able to source another one.
Yeah.
That said, if we have the name of the contractor, which is really important if the client doesn't have any experience, we'll still do a search to make sure that we're not dealing with
there's nothing dodgy going on.
Any criminals, and there's maybe no adverse media around them, having projects that have gone awry. But no, we're certainly not looking at the accounts of a contractor that's involved, unless they're a shareholder in our underlying company.
In which case you wouldn't.
In which case we might do a heightened level of due diligence, but certainly not if they're just a contractor.
Okay. And we briefly touched on 2024. So just talk us through kind of what 2024 was like overall for Octane.
It was great. Like I said, it was our best ever year. We've hit a number that we've never achieved before within short-term finance. We added 100 million more on than we did in 23.
Wow.
Grew the team, launched new branding, tried to increase our exposure across marketing and events. I think really what we've done quite well over the last couple of years is just double down on what we're good at.
Yeah.
I don't think that there is room in the market for a middle of the road bridging lender that just does a bit of everything. Brokers, and I don't envy brokers, there's so many lenders competing for a broker's attention that it must be, correct me if I'm wrong, a complete nightmare to work out who to listen to, try and remember and retain information. So what do we want brokers to think of us for? We want them to think of us as a refurbishment lender with keen pricing that structures deals in a way that gives the client the max day one. A development exit lender that, again, very keenly priced. They are the two areas that we are what we think market leading in. The rest we can do. And if you want to bring us an auction deal or a foreign national or a adverse credit deal, look, we can do those deals too. But they are the two areas that we're really strong in. And so amidst all that noise, our noise is focused into those two channels.
Absolutely. One thing just jogged my memory actually on one thing we spoke about this morning, which was talking about funding lines and surety of funding. And I think actually this is key to talk about before we go into sort of talking about 2025. But there are a number of lenders who, it seems recently, have either taken on new funding lines or going down the peer-to-peer route or whatever route it may be. But getting to the point where they'll issue an AIP, issue an offer, get the whole way through the process, and at the point of drawing down funds, then go and seek funding line approval. And it's a huge risk for investors, developers, and brokers as well. So from Octane's point of view, what are you doing differently, which would give clients that surety and brokers that surety that they're not going to get screwed over at the final hurdle?
We certainly try not to do that. I think you're right. Look, 90% of lenders in our space they borrow to lend. So they have funding lines, and often they have multiple funding lines, and typically they're finite. So once they've exhausted one, it has to be replenished. And you're right, some lenders will have a investment committee, a funding line approval process where they have to get that deal approved just before you complete. I suppose we're slightly different to other lenders in that we have one funding line. They funded the vast majority of the deals that we've lent since we launched in 2017. They now fund all of our deals. And very crucially, they're an equity partner in the business. And that's one of the reasons why our cost of borrowing is quite low and our rates are so cheap, is that I think they see value in the equity of Octane. We are essentially one and the same as our funding line. So that means that when we get towards the end of a loan, we don't have that uncertainty as to whether it will or won't be approved. In fact, I would say, assuming everything that we're told at inquiry level is true, our terms of credit back to AIP stage, and we turn around AIPs in a couple of hours. If the numbers are right, nothing comes out of the woodwork in terms of the borrower experience, where they live, whether they've got adverse credit. And that stuff does happen. But if it doesn't, and there's nothing nasty in the legals, those terms will be the terms that we complete on.
Okay. And in terms of just talking about stuff coming out of the woodwork, and I really do want to talk about 2025, but all these questions keep coming out. In terms of clients, stuff coming out of the woodwork, etc., if a client wants to go into a deal with none of their own money, comes up on pretty much every deal we deal with. They either want investor money to come in, or they're buying below market value, or whatever it may be. What's your stance on client equity in a deal?
Firstly, client equity in a deal is important to lenders because it just, you'll hear this phrase, skin in the game. It just means that they have their own cash in that deal and are perhaps are going to be more motivated.
Yeah. They're not going to wake up one morning and go, I haven't got any money in this deal, I'll just walk away.
Exactly. So firstly, client cash in the deal is objectively a good thing. That said, we're like you. Loads of the deals that we see have investor cash, and quite often it's all investor cash on the way in.
Yeah.
And we have no issue with that. So as long as we can do AML checks on the investor cash going in the same way that we would for a borrower, we're happy. What we would normally say is we would cap the loan to GDV at 65 if the client doesn't have any of their own cash going in. We can still be at 75 day one, plus the refurb costs, but we would cap at 65. However, if you've got a investor that's willing to give a PG, we could essentially treat that as if it were borrower cash going in. Yeah. And that helps us push the loan to GDV back up.
And do you see that very often? Because it's come up a few times recently, and often I'm met with an investor going, absolutely not. Do you find that happens very often?
Sometimes they say absolutely not. I guess it depends on
what they're getting out of the deal, isn't it?
The investor's involvement, how close they are to the underlying borrower. We present both options, and sometimes they take it, sometimes they don't.
Interesting. So coming into 2025 then, so we're at the point of recording, nearly through the first month somehow already. What does 2025 have in store for Octane? What are the targets? What are you looking to achieve?
Yeah, there's a few milestones for us this year. So we turn 8 soon, 8 years old as a business. I think we will hit £2 billion of lending before we turn 8. I think, I'm looking at my colleague Richard over there, our MD of sales, I think we'll hit that by the end of Q1, certainly in Q2 if not. Fingers crossed. So they're two big milestones, turning 8, surpassing £2 billion of lending, which we're so proud of. We've scaled, a new entrant to the market really quickly, which we're very proud of. We want to add another 300, maybe million onto our book this year, surpass our lending for the previous year. And really from a sales and marketing perspective, it's just more of the same. Double down on those two areas that we're really strong in. Richard's done a great job in growing our team. We've now got 9 external BDMs. So we cover the length and breadth of the country, making sure brokers have that face-to-face support.
And in terms of, obviously you said about doubling down on the two, so dev exit, again, is going to be a massive part of your year this year, I'm guessing. And do you see the trends continuing in terms of developers' need for that? Yeah,
in the same way that we were talking about the HMO piece, I think if you look at the broader market conditions for developers, there's 3 things that are happening. Undoubtedly, sales have slowed.
Yeah.
So, and I think if we talk about uncertainty around buy-to-let rates, there's also uncertainty around mortgage rates.
Yeah.
And for as long as that swap rate volatility is causing volatility in mortgage rates, that will breed inertia among home buyers. If you think you're in, Mr. and Mrs. Miggins are in rented accommodation and they're trying to decide whether to make their first move into a house that they own, do you think that now is a good time to be making that move? Or do you think that some people might think, let's just wait and see if rates drop to 3%, and mortgage rates come down? And that uncertainty causes a lack of demand, or in terms of owner-occupied new build properties. So developers will be feeling that. In addition to that, build costs have skyrocketed. So it's very likely now that developers will be eating into their contingency. Yeah. We often see developer exits where the client's actually exhausted their development facility. I'm sure you see it too, where there's no cash left.
Far too common,
Yeah, the development lender's maxed out. They don't have enough cash to finish it, and they don't have their own resources. So they actually need cash to be able to hit PC. And the third piece of that is that development lenders are becoming, it seems to me, from the outside, more aggressive in terms of wanting to be repaid.
Yeah, very much so. Yeah.
I don't know, it'd be interesting to see your thoughts on this, but it doesn't seem to me like development lenders are being very generally speaking, willing to give extensions?
Yeah, so even going back 2 years probably, so coming out of COVID, etc., we were seeing minimum 3-month grace periods. So lenders would, without a shadow of a doubt, say, you've got 3 months with no penalties, no extension fees, no interest hikes, anything like that. Now it's very much, you go a day over.
Really?
5%.
Yeah.
In terms of a default fee, which, I mean, only one lender does that, thank God. But we're talking those kind of stupid figures where you've literally got people, I've got one at the moment, which is a dev exit, which it runs out at the end of January. Their investor, I think back in November, had said, if you run over, it's going to 2% a month.
Yeah,
all
default
these default
interest.
fees. And it's 3 months away from finishing. They'd already sowed the seed of, we are going to hit you with everything possible.
I had a deal that completed last year. It was my biggest deal of last year. The client admittedly had extended the development loan once. So he had already a 3-month extension. He had 6 weeks left on his development facility. The units were completely finished, on the market and selling fast. So it was a perfect developer exit scenario for us.
Yeah.
Liquid, complete units. But they wouldn't give him an extension. And they were threatening him with enforcement action. He had 6 weeks left. So for him, he's thinking, look, I've spent the last 2 years or more, if you went through planning, developing this site, to risk actually losing these assets before I've realised any profit. Madness. And I think, again, using the bridging scenario as a tool for developers, this is helping developers to not have to rush through marketing their units.
Yeah.
You want to have time to be able to achieve your desired price points. You don't want to slash costs because your development lender needs repaying urgently. You want time to market and sell at the right level.
Yeah. And I think it's actually key with development exit. Everyone kind of, and I find this, clients will come to me and they only ever take development exit when they're up against it.
Yeah.
And actually, to me, I think there's a whole other side to development exit, which is, let's say you're a first-time developer. So you're building a new build site. You're probably going to be at, as a first-time developer with limited experience on a decent-sized site, you're probably going to be at 12, 13% minimum. It baffles me how many people don't look at that and go, if I rush it through to, and even to the point of, and obviously I appreciate you don't do necessarily the wind and water stuff, but there are other lenders who will take it from wind and water stage. I don't understand why first-time developers don't just rush it through to wind and water or practical completion, or what? Not even practical completion, but to within 10%, like you said earlier, and then refinance.
Yeah,
because the amount of saving that they could make is
totally, and it's not just cost saving; it's also cash.
Yeah.
So if you've developed 5 properties and you're geared at 60-65% with your development lender,
you're not going to see anything until the last 1.5.
Correct, but equally, if you have another, and most of the developers that we deal with have in fact, every developer that we've ever lent to is cash strapped for one reason or another. And it's usually because they have multiple sites on the go. So like you said, get the site to where it's nearly finished. You're geared at 60-65% maybe with your development lender, or maybe even 70. Gear up at 75% on a developer exit. Pull out your cash, pump it into a new project. But also, if you're borrowing from us at 0.74 a month, it's very likely that that's cheaper than your development rate.
Oh, big time, yeah. And the saving, if you work it out, I mean, on average, every development is going to have built in 6 months as a sales period, minimum, you would have thought. So realistically, if you can rush it through to PC or to within that 10%, you're probably taking, on average, an 18-month term. You can probably get to that point within 9 to 12 months. You're potentially saving cash then on, between anywhere 6 and 9 months, which the saving on that, off the top of my head, you're probably talking minimum 1.5 to 2%, which on
the other thing is that maybe what deters people is they think it's going to be a big hassle going through, the process with another lender. But there are things that we do to try and make it smooth. So can we use the same valuer? To come back to our point from before,
9 times out of 10 you probably can.
Yeah. So if we can use the same valuer, they've already been to site, maybe they've even monitored it.
Yeah.
So that can be handy. If the developer is using the same solicitor that acted for them for the development finance,
everything's on file already.
It's usually just a data dump
Yeah.
Of all the information that we need. Sometimes we can borrow searches from an incoming buyer. If one of the units is already sold, it's likely that searches are held between solicitors.
Yeah.
So there's lots of things we can do to try and facilitate a really quick and seamless completion.
Yeah, I think that's key. And I think dev exit side of things, I think that education of getting first-time developers in will be key. In terms of, and this kind of touches on the 2025 stuff, but obviously stamp duty changes coming in the next few months. How do you think that's going to affect things moving forward? Because it could slow down sales, but will it? Who knows? Depends on the size of the site, I guess. Do you think it's going to be beneficial?
Well, I think developers might feel that a spike in completions will be welcomed. I think we've seen this a couple of times where there's been a deadline for stamp duty change, and then you see this mad rush to try and get things through.
Yeah.
So I think developers will be welcoming of that.
Every man and his dog, I think, is going to be trying to get a completion through by the
I
end
think
of March.
if you have I think the good thing is that if you have an offer accepted on a property as a buyer, it's very likely that you will be going hell for leather to try and get that completed before the changes. So developers will benefit from that spike. I think the broader picture is that everything's becoming more expensive, whether you're an investor or a home buyer. And that's Labour's that's their policy. You know, they're looking to collect as much tax as they can from anyone they can.
Anyone they can. And then the last question, the last prediction for 2025. Obviously yesterday, at the point of recording this, yesterday saw Trump sworn in as the 47th president.
Yeah.
What do you reckon that's going to bring? Do you think it'll have any impact on the property market, or is it really a case of time will tell?
Yeah, I'm not sure. Yeah, I'm not sure how much impact Trump will have on our sort of corner of the UK property market, which is all I'm really sort of licensed to talk about. I think the kind of broader economic picture in the UK is improving, albeit very slowly.
Yeah.
I think what we can say with some certainty is that we'll see at least one more reduction in the base rate. That's good for everybody. It's good for lenders and their cost of borrowing, and it's good for buyers. It should gear up demand in terms of owner occupiers to help developers, and it should implore investors to kind of rev up activity too.
Brilliant. I lied. I've actually got one more question. Because what you mentioned, it just triggered a thought actually. What are your thoughts on
Trump?
How long probably can't keep that in. Well, actually, funny enough, thinking about Elon Musk and obviously his involvement and everything else kind of got me. No, I'm not going to. But it got me thinking about technology and the use of technology, and we are seeing a hell of a lot more technology coming into our corner of the market. Because I remember 6-7 years ago, as you probably do, there was no sourcing software. There was no anything in our side of the market, and now it seems that as we move on, the bridging and development space is getting quite heavily dominated by technology. It feels from our side of things now. So what do you think about that? Are you welcoming the change, or are you not really seeing much of a change?
Yeah, I think, I know our CEO, Jonathan Samuels, is very keen on enabling AI to kind of take our business to the next level. And we've had a consultancy into the business to look at all different all different facets of our business to see if it can help us become more efficient.
Yeah.
So whether that's reviewing inquiries, reading valuation reports, obviously it still requires the human input, but can some of that legwork be done via AI? So that's something that we're looking at. It's still in the process. But I think any business, whether you're a brokerage or a lender or an investor, you've got to kind of start looking at this stuff.
Yeah, absolutely.
At risk of being left behind. But I also strongly feel that our end of the market, the specialist end of the market, because it's kind of intrinsically more complicated, requires human input. So I'm hoping that my job isn't at risk anytime soon. Again, looking over at Richard.
I think you're right. I think our corner of the market is very, very different. I think that's where some investors and developers get maybe a bit out of touch with how our side of things work. Because the amount of people who come to me and they say, oh, do I need to get an AIP before I then go and offer on a property? It's like, well, no, actually, a lot of this is asset-based lending. It's all based on that one individual inquiry. Whereas if you go and get a residential mortgage or something like that, you input a few details, a computer somewhere
it's interesting
determines what you can buy.
How limited I think you're right. So I think about when I bought my house, the level of legal due diligence that went into that was so nominal.
Yeah.
And often people ask why a bridging lender is asking more questions than their mortgage lender, NatWest, on their house. But I think, like you say, it's an asset-based play. And as a much smaller lender, you have greater exposure to a single deal. So you have to make sure that you're not going to lose money on that deal.
Yeah.
So that heightened level of due diligence becomes more relevant.
Yeah. And I think the thing with our side of the market is it is one big sales pitch. And there is no computer anywhere that goes, yes, you can have a bridge for $100,000, or yes, you can have a development loan for $100,000. Because I think this comes back to the technology point, is I think no matter how much we automate and use technology in our side of the market, I don't think we're ever going to get to that point, because we have to be able to look into the whites of people's eyes and go, are you going to deliver that project or not? Whereas a computer can determine whether, based on my income, I can have a house or not. Yeah. That's fine. The computer can decide that.
And what we do in bridging is not, like even buy-to-let lenders, standard house, what's it worth, how much is the yield, apply their ICR, this is how much you can borrow.
Yeah.
That's not what we're doing here. Like if we're doing a refurbishment loan, there's so much to that in terms of asset, in terms of borrower, and in terms of exit. And there's a degree of subjectivity to it.
When there's so much that can go wrong, isn't there? I mean, literally at every stage, there's something that could go wrong. And I think because it's over 12 months as well, a lot of it is within that 12 months, literally, there are potentially 12 opportunities for something to go wrong, for someone not to get paid, for someone not to turn up on site, for someone to do X, Y, Z wrong. Whereas you take a mortgage, you pay every month. If a tenant misses a month, there is a process to go through.
Yeah.
Whereas if a contractor disappears off site, most of the time you're sitting there going, right,
for sure,
what do I do?
And you've got to realise that let's talk about the mechanics of getting a deal approved at Octane. You as the broker send me a deal, I package that deal and send it to a human, an underwriter, a person in our credit team who we, Mr. Broker and BDM, together, we have to present this case in a way that it's going to be approved. And coming back to this kind of persuasion piece, is that if your inquiry is lacking detail, or if you're showing that your client hasn't thought about the right things, you're just increasing the chances that the terms that you receive back, if at all, are going to be favourable.
Brilliant. And I think it brings that technology piece to a nice route. And I think it'd be interesting to see how AI is used in our space, if at all. Because I think, like you said, I think there is an element of allowing things to become more efficient, but to a degree, unless solicitors take on AI and become more efficient, we're all buggered anyway.
No comment.
There's just that is a pinch point, and we could do a whole episode on solicitors and delays and everything else. But I think for now that brings us to a very nice close.
Thank you for having me.
And yeah, it's been a pleasure. And thank you very much to everyone who has listened and watched this one. Catch you on the next one.